Hi, good evening, everybody, and thank you, Geraldine, for the introduction. So I'm JP, and today I'll be sharing with you my presentation in terms of how I started my investment journey. So just like the markets, this journey has seen a lot of ups and downs. Along the way, there were euphoric moments where nothing seems to go wrong, only for Mr. Market to remind me otherwise. And even now today, with a lot more white hair and wrinkles, I am still learning new things from the markets. I started working in the second half of 2003 as someone who just joined the workforce amidst the SARS situation and pandemic back then. My main priority was to take the first job offer that came, save up and build up some emergency funds. The fear over SARS and what this meant for the economy and jobs also led to me actually not prioritizing my investments. But I finally made my first investments in March 2005. Which is actually in the age bracket that the majority of investors just now are in for their first investments when they took the poll. So no surprise there perhaps, for my first investments, they were actually via Fundsupermart, as FSM1 was known back then. I thought I bought an Asian equity fund as my first investment, but when I was doing this presentation deck, I actually checked my investment account and historical transactions, and I found out that in 2005, I was in a very pro-China mood. The first investments I made were in free funds, all invested into China, Taiwan, and regional China. As you can see, my concept of diversification was non-existent. So back in 2005, the long-term case for China was solid, and even today, I am still very optimistic on my China investments despite all the troubles we have seen in the last few years, what with the US-China trade war and the battle for dominance in technology and other fields. Strategy-wise, looking back, I didn't have any, but it did turn out to be profitable investments, and I took profits around 2006. Investing to me was about taking short-term profits back then. The concept of every drop adding to an ocean was something important to me. Of course, in hindsight, if I had taken a longer-term view and outlook, I would have done better, I think. So, of course, past returns are not indicative of future performances, but if you look at this table on this slide, you'll find that the Regional China Fund here from SSA would have given a decent return if I had held it over 10 years, an annualized return of about 10% in fact. And that is an annualized return I would take any time gladly. But one thing I learned is that markets don't stay down forever, nor do they go up forever. So if I look at this slide, which represents the Asia ex-Japan market, I think that really explains and sums it up very well. So when I look back, the post-SARS period was actually exciting because that was the beginning of a golden bull run era for Asian markets. The 2003 to 2008 period, as you can see, meant that investing in single markets and Asian markets was actually quite easily profitable. But as you know, when things are too easy, I think you will agree with me that we don't take away very useful lessons from the experiences. And the excesses leading up to the dot-com bubble of the late 1990s, as well as those leading up to the great financial crisis in 2008, I think those showed us clearly that when there is too much exuberance with little disregard to fundamentals, things will end up badly. And as we all know, they did end up badly in the GFC period. Many markets fell by over 50% in a matter of just a few months from the 2008 peak. I did not sell all my investments back then and somehow stayed invested mostly in Asia. The GFC downturn was painful, but recovery did come, as we can see again on this slide. But it was not a bed of roses. Along the way, there were bumps. So for example, in the second half of 2015, the China markets fell off the cliff. Asia was not spared because of the growing prominence of China. But again, there came the recovery until, of course, the COVID-19 situation happened last year. But in a very surprising twist, there was a swift downturn followed by a very swift recovery, as we can see from the slide. So here I use the example of one fund that I've been holding on for a long time, probably the longest in my portfolio, which is the Dividend Advantage Fund, an Asia Pacific ex-Japan equity fund. So over the last 10 years, the annualized performance of this fund is roughly about 9% per year, which is superior to the 7.4% for the FSMI Asia ex-Japan index. So this FSMI index is basically an aggregate of all the Asia equity funds distributed on FSM1, and superior, of course, to the 4.99% from the MSCI Asia ex Japan Index. What I wanted to share with you here is that in some markets, such as Asia ex Japan, there are some fund managers who can outperform the indices over time. Of course, I should also add that depending on the time periods, so if you look at the shorter time period of, let's say, 3 months, the funds may not outperform the indices. But given a longer time frame of, let's say, 3 years and more, the better managed funds and regions such as Asia and emerging markets, they can outperform the indices. So I think if I recap, investing in my 20s can be summarized basically in 2 points. First, I had a very short-term outlook. Second, I had zero diversification. Strategy-wise, I needed an investment plan with a lot more steps and discipline. And that is something that I hope I can share with you over the next few slides. So first point, what's the real purpose behind investing? I think back to the main topic that I was given today. So why am I investing? The obvious reason is to make more money. But I think we should link that to our different life goals. And here, I'd like to bring up the concept of having different buckets for different life goals. So at different times of our life, we will have different priorities. But one of it never changes. And that's the ability to have some emergency funds that are liquid, but can comfortably beat the terribly low interest rates that we get from our savings accounts at the banks. So bucket one, I'll call that the emergency funds bucket. Depending on our lifestyle, some of us may want to have up to 6 months, all the way to up to a year of emergency funds that can cover our monthly expenses. The other buckets, depending on what stage of your life you're at, it can be a marriage bucket. And usually that comes, of course, with an expensive purchase, which is your first home purchase. Other buckets can also, of course, include a retirement bucket. So going back to this second tip 2, I just wanted to draw your attention to something that happened on day 1 of our What and Where to Invest 2021 event. We did 2 polls back then, and in one of the polls, if I recall, 50% of you said that you didn't catch the market bottom in 2020. And I think the bottom was roughly around March of last year. In a second poll, 80% of you said that your portfolio was making money by the end of 2020, which is great news. So just based on these polls alone, it shows that catching the bottom is not a must to ensure that we're making money. Of course, there's a lot of excitement and bragging rights to tell our friends that, hey, I caught the market at this bottom. The truth is, we cannot do it consistently. And as investment guru Peter Lynch says, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So if you look at this slide and this chart, we'll find that over a period of slightly more than 30 years, it is actually better to stay fully invested. And the reason is, the key point here is simple, because markets move really fast. And if you miss the top performing trading days, the portfolio would end up worse off. And that is essentially what we see here for 5 major equity indices. So there is wisdom in the saying that time in the markets beats timing the markets. History shows that markets go up and down and not in one straight line. I like to make references to Howard Marks, another investment guru who wrote the book Mastering the Market Cycle. So all markets go through cycles. So he used the example of how markets swing like a pendulum from left to right and rarely stay at the center. What this means and what this table shows and supports is that markets who end up as a winner in one year will not necessarily end up winners every year. So in the year 2017, for example, as you can see, the US market was bottom of the list, but the next year in 2018, it ended up as the best performing market, albeit of course with a negative return because 2018 was a tough year for equity markets. Having said that, if you look at the table closely, the digital economy did very well in the last 4 years, which is a reflection of how much things have changed for the different sectors within digital economy and how they have progressed and innovated, and also how investors have been willing to pay a premium for that. And that accelerated even further in the COVID year of 2020. So the key to navigating through market cycles is diversification. Here, let me start with one form of diversification that is at the asset class level. Essentially, we're talking about 2 main types of asset classes, which is equities on the one hand and bonds on the other hand. So it's an inter-allocation between a choice of how much you want to allocate in equities versus bonds. So if you look at the different types of portfolios here, you probably see as a reference point that conservative portfolios may tend to suit investors who have a lower tolerance for risk. They may not be able to accept if markets, let's say, go down by 10, 20% or more, and they probably lose sleep over that. So they probably will gravitate towards the more conservative portfolios. But if you are an investor who cannot stand having 2 to 3% annualized returns, then perhaps the more aggressive portfolios would be a more suitable reference point for you. So here you also find that in a neutral market environment, we advocate the settings which are in the table below. But when we enter 2021, we also hold a view that we actually prefer equities over bonds. And therefore, we are adding 5 percentage points to the different asset allocations you can see. And that's reflected at the top part of this slide. The only exception is for the aggressive portfolio, because no matter what market conditions, we always advocate that you have at least 10% in the bonds portion of the aggressive portfolios to act as a cushion for you. So on the previous slide, I spoke about inter-allocation between equities and bonds. Here, I'll go one level deeper, which is in the form of intra-asset allocation. So that's essentially within equities, what should you invest into? And likewise for bonds, within bonds, we ask ourselves, what should we invest into? So if I use the bonds portion as an example, for those of us who manage our money from a Singapore dollar perspective, we will have a relatively big portion in Singapore-centric bonds. Then for further diversification, we will have some global bonds, some Asian investment grade bonds, and high-yield bonds, for example. So there's the neutral allocation, as you can see in the table, as well as the current stance. So the current stance reflects our view as we enter 2021. And we are overweight certain sectors, for example, emerging markets bonds and Asian high-yield bonds, and either neutral or underweight the other types of bonds. For investors looking for yields, emerging markets and Asian high-yield bonds continue to offer attractive spreads, we believe, at this point of time. Within equities, we have overweight in Asia ex-Japan, Latin America, and China. I think the one which stands out here perhaps for a number of you is the digital economy, where we have an underweight position. That's simply because of the huge run-up that we have seen in 2020, and valuations have really surged. And we believe that this sector has gotten a little bit expensive. So our research team is suggesting that we take some profits off the table, still keep it, but trim the position in digital economy and move into other more attractively asset classes, such as the financial sector. Here, I want to bring up what we call the core and supplementary portfolio concept. Simply put, the core portfolio has the dominant markets and sectors which we expect will continue to be important in the future. So in the last 1 year or so, we actually introduced China and digital economy to be inserted in the core portion. And that's to reflect our view that these are going to be long-term important building blocks in any portfolio. But for many of us, including myself, I like to have tactical positions as well into something that can give me the extra potential boost in terms of returns. And of course, remember the pendulum that I was talking about, which can be boosted up, but can also be boosted on the way down. So from a risk-return perspective, we are suggesting that tactical ideas, while exciting, they should be kept to, let's say, roughly about 20% of your overall portfolio, and the remaining should be about 80% in the core portion. This point here is about market fundamentals and why it always matters. So in the shorter time period, when there is a lot of exuberance in a certain market or sector, the danger is that fundamentals may be forgotten. So when markets experience excesses, it is the quality companies with good fundamentals, be it in terms of earnings growth, business model, balance sheet strength, and so on, that will stay strong in the longer term. So looking at the Asia ex-Japan index, you can see the performance in blue here. The orange line is the earnings growth. First, you will see that there is a good correlation between earnings growth and the market performance. That makes a lot of sense. If a stock makes money, investors will reward that stock, right? So the same goes for an index, which is made up of many stocks. But a question we should also ask or think is what lies ahead for that market. That's where our analysts bring up the expected earnings growth forecast for this coming year, 2021, as well as next year, 2022. And we compare to the usual valuation of the market, and we see what's the potential upside lying ahead. In this case, for the Asia ex-Japan market, our research is pointing to roughly 18% return by 2022. If you're interested in such analysis, we have more information on our website and mobile app, and Colin, my colleague from the research team, will be sharing a lot more in his presentation later on. This tip is something that I've learned over the years. It's simply about having a regular savings plan, or RSP. And I think that's one key strategy that I would advocate to any of you. And I've implemented that quite dutifully or diligently throughout my 30s. So an RSP gives me a lot of discipline because it forces me to invest every month. I can change the amounts anytime. I can start or terminate an RSP anytime as well. An RSP allows us to benefit from the concept of dollar cost averaging. So when markets go down, if I invest $100 a month into a certain product, well, that gives me more units of that product. I will not be sitting on the sidelines trying to time my entry in the markets when the markets revert back to going up. So I'm essentially always fully invested. I would like to quote someone else here, the investment guru Benjamin Graham, who said, "The investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave." So I think an RSP removes all that emotional behavior and keeps us very grounded in terms of our strategy. And of course, an RSP works very well for more volatile markets and more volatile conditions as well. RSP as well allows us to enjoy the power of compounding. So personally, for all the funds that give dividends for myself in my portfolio, I'll choose the reinvestment option to enjoy the power of compounding. At FSM1, we have a few tools, including the RDSP Calculator, which you can use. You can input your monthly RSP amount and any lump sum amount that you would like to invest, and you can choose a time frame, for example, 5 years, 10 years, 15 years, or 20 years. And what that will do is it will churn out a chart and a table for you in terms of how much that portfolio can possibly grow to. So if it's a time frame of 5 years, for example, and assuming you put 1K every month, and you have a lump sum investment amount of 10K, it can grow to close to 100K in roughly 5 years, assuming a 12% annual return. And when people say that let time work its magic, it's very, very true in the markets. So if you invest the same amounts I mentioned just now, but over a longer time frame of 20 years, instead of 5 years, instead of 100K, the portfolio can grow to $1 million based on the same 12% return assumption. So now moving on to how I'm planning my own portfolio. This is something that I do based on my own life goals, and I have different life goals, which means different buckets. So for bucket number 1, it is relatively simple in terms of my objectives. Beat the savings account rates comfortably. That is definitely not hard to achieve actually. And this objective of mine applies for both my cash as well as my SRS money. So back to bucket number 1, I go for a number of funds. So I'll run through the first few here. So firstly, money market funds, for example, the Lion Global SGD Money Market Fund. Secondly, short duration bond funds like the Nikko AM Shenzhen Short-Term Bond Fund SGD. And thirdly, Singapore-centric bond funds like the East Spring Singapore Select Bond. It's important to see that these funds display a certain amount of volatility, as you can see in the graph. So do make use of our tools, such as the chart center and the fund selector, to look into the volatility and as well the returns of the different funds. This second bucket is for my children. So I want to build up something for them in terms of investment amount that they can use in future for their future education, or something meaningful in terms of perhaps some future endeavors that they have in mind. And also, when they are old enough, because they're still very young at this point, I hope that they can appreciate the value in investing and do their own investing as well. So here I chose the FSM managed portfolios, and very specifically the moderately aggressive portfolio. The neutral inter-asset allocation is roughly 70% into equities and 30% into bonds. The portfolio has done pretty well since inception, which is about 4 years ago. It has returned roughly about 9.5% per year. The last 1 year, of course, in a certain bull market, right, has done especially well with a 17.4% return. I think the FSM managed portfolios are a good choice for those of us who want something more ready-made, and we want to leave the asset allocation to the portfolio management team, as well as the decision to rebalance the portfolio to the portfolio management team as well. So if I can go back to last year, I think one of the decisions that the team made which helped was the inclusion of the digital economy ETF, which we call OGIC, roughly around April of last year in the core portfolio in the equity portion. I mentioned about equities to bonds and why we prefer equities to bonds. So we have an extra 5 percentage points in equities. So going back to my moderately aggressive portfolio, so the equities add up to roughly 75% of the portfolio and bonds add up to 25%, as you can see on this slide. I also mentioned the concept of core versus supplementary. For this slide, what you can see is the free ETFs which are inside the supplementary portion of the portfolio. These consist of our favorite tactical ideas, which is digital economy, Chinese technology, and semiconductors. Please note that the information is as at 31st December of last year. So our portfolio management team is looking to make some tweaks for the supplementary portion. I think you kind of guess roughly what they're going to do. They're going to take some profits off from digital economy and especially the Chinese tech ETF and introduce the financial sector, which is a beneficiary of the broader global economic recovery that we're seeing and the expected earnings growth revisions that we will expect to see as well, and a fall in loan loss provisions, which a number of my analysts have alluded to in previous presentations. So here for the third bucket for my retirement, I'll be sharing a bit more about how my portfolio looks like in terms of my retirement goals. And it's essentially in funds and ETFs across both cash and SRS payment modes. So I invest based on a long time horizon of roughly 15 years to 20 years. I also like to have a mixture of lump sums and RSPs. So this is where my position stands at the start of this year, 2021. So it's something personal. It doesn't apply to everyone. As you can tell by now, I have a bias towards Asia. So besides my core Asia fund, you can also see from this table, from this slide, right, that I also have a position in Asian small caps. And with the recovery that we expect in Asia, I thought it will make sense to look into some of the smaller companies in Asia. So here I went for the PineBridge fund, for example. I also have an exposure to Asian REITs, which have seen a very K-shaped recovery because the outlook is very different for the different REIT segments. So I have an ETF here that is invested in Asian REITs, and there's a lot of representation from SGX listed ETFs, but you also find some exposure from Hong Kong listed REITs as well. I use the term digital economy very broadly to include disruptive innovation and related themes. So in my portfolio here, I have the Nikko AM Disruptive Innovation Fund, as well as the Lion Global Disruptive Innovation Funds, which I invested using my cash and SRS respectively. I also have an RSP in those funds. After the run-up in these two funds last year, I'm staying invested. I'm prepared for the increased volatility in those sectors, which will happen because no investment, as I have said, will keep going up in a one straight line because those investments have done really well last year. I'll stick to my RSP strategy, which actually works even better with funds when markets are more volatile. But I'm adding to a new position in financials. I went for a global financials fund as well as one that is more focused on fintech. So essentially that captures my portfolio positioning at the start of this year. And with that, I thank you very much for your attention. I just wanted to end up with a few words. Investing, I think it's a journey that continues to teach me new things, even for myself. And I hope that no matter what the markets throw to us, be it good or bad experiences, we'll always take it as something that we can learn from and we can invest better and more profitably. So have a very happy, healthy and hot year. Thank you very much.